This latest FOMC minutes report that came out today really makes you want to find a beach, find a party, grab a drink, really enjoy yourselves because stocks might just be off to the moon again. Maybe. But one statement in particular does stand out, and I think it was more of a last minute thing from the Fed to hopefully spark some fear in financial markets. And it goes like this: individuals should focus more on where rates are going than the path to get there. Yes, I did just paraphrase the out of what the Fed said right there, but really to put it into English for you guys is the Fed said don't worry about a 50, 25, 75 basis point rate hike from now on. He says that doesn't matter. He says what matters is where the federal funds rate is going to go and where that terminal rate is going to be. If you guys don't know what the terminal rate actually means, it's essentially saying the rate in which the Fed will not raise rates anymore. Meaning that could be 5%, that could be 6%, it could be 7%. The markets currently expect 5 to 5.25% is that terminal rate. This terminal rate discussion could send the markets down in the next couple of weeks. But for now, why are the markets so bullish on the Fed minutes? And one of the biggest statements of bullishness, or at least that caused bullishness in the markets today, is this one. A substantial majority of participants judged that a slowing in the pace of increases would likely soon be appropriate, the minutes stated. The uncertain lags and magnitudes associated with the effects of monetary policy against on economic activity and inflation were among the reasons cited regarding why such an assessment was important. That statement makes you want to go, hell yeah, we made it, the tightening is almost over. And then you get this statement. Though hinting that less severe moves were ahead, officials said they still see few signs of inflation abating. However, some committee members expressed concerns about risks to the financial system should the Fed continue to press forward at the same aggressive pace. That statement was a real mic dropper, and literally Fed Jerome Powell, whoever made that statement, those few members, just dropped the mic on the markets, and the markets didn't even realize it. They're basically saying that there is financial instability, that there might be a problem in the financial system, and the system might not be able to handle it if they continue to raise rates as aggressively as they were. But this likely comes to us as no surprise. Mortgage demand, after all, is at a 22-year low. The value of cryptocurrencies has dropped from a high just 1 year ago, almost to the day, at $2.8 trillion, now down to $800 billion, and even the UK gilt market, equivalent to a United States Treasury bond, has effectively failed in 2022, and now the Federal Reserve cites this as a reason to slow down the pace of rate increases at a time where inflation is at a 40-year high. So take it as you guys please. I think that was really the one line in this that was bearish, and for more downside in the markets, I personally think it's coming, and it's probably going to come in two ways. It's either going to come because Fed Jerome Powell tells us that, yeah, we might have to go higher than 5% or 5.25%. In that case, markets have not priced that in, and that would cause a very violent downside move. I think that goes without saying. And on the other hand, it all depends on company earnings for 2023. That's what investors are trying to do right now, is figure out companies that will do well in 2022. Maybe they all will. Maybe a lot of them will. But a good portion of them are probably going to see contracting earnings, and a lot of your large tech stocks like Apple and Amazon and Google, those might be the ones that falter the most, and they control the broad indexes. So I think it's safe to say 2023 is probably not going to be a good year for the index fund investor, at least in my personal opinion. But if we come over to the charts and take a look, it looks incredibly bullish, and it's no surprise why the markets actually rallied today off of the FOMC minutes. So you have this bull flag indicator, essentially this top trend line running from the peak of the rally we seen in August down to the last peak that we seen just a couple of days ago on November 15th. I've had this drawn out for a couple of days now, essentially saying if the markets break to the upside above this downtrending level of resistance, that's probably going to mean a positive move to the upside. It's probably going to be a very good bullish indicator. Or if the markets fall back down to this ascending level of support, that's probably not going to be a good thing. And we got a clean break above that here today, like the cleanest break you could possibly hope for. So it looks like the bulls are in control for now. The bulls also have seasonality in their favor. November and December tend to be some of the strongest months to be in the stock market, posting some of the most impressive gains in that time period, and also the infamous Santa Claus rally. But the biggest thing that is really helping the markets rally as of right now in the month of November is the CPI report that came out earlier this month that indicated prices in October went down at a much faster clip than what people were expecting, and the numbers were phenomenal. We were expecting a 0.7% increase month over month to core PCE. That came in at 0.4%, much better than expectation. So I think the bulls are firmly in control for the time being, given all of these factors that we just went over. But the next data points that come out will be super important, and we do have another Fed meeting coming on December 14th, and you will get inflation data coming out December 13th, which could make and will make for a very volatile month of December as well. Now, let's not get too ahead of ourselves talking about December, because you got news catalysts that will be coming out next week, starting with on Wednesday, the JOLTS job openings for the month of October. We are expecting 10.71 million job openings. If that number comes in higher than that, well, you're going to be in for a pretty big red day, more than likely. If you see that number come in under that 10.71 million job number, well, it's probably going to be a pretty bullish reaction in the markets. And then on Thursday, you are going to get personal income and personal spending month over month for October coming in at 8:30 in the morning. That is also going to be one of those data points that can move the markets 1 to 2%. I'm not expecting a huge day from this number, but it can and it will give you a move, especially if, estimates were very wrong, and that could be to the positive side or that could be to the negative side. As you guys know, good news economically speaking is bad news for the markets. Bad news economically speaking has been good news for the markets in 2022. You have ISM manufacturing PMI coming out at 10 o'clock in the morning as well on Thursday. Then on Friday, you're going to have one major piece of data, and that is going to be the unemployment rate for the month of November. We are expecting 3.8% unemployment. Last month we were at 3.7%. So if that number stays the same at 3.7%, that's not going to be a good thing for the markets, especially if that number moves down some way. We've seen crazier things happen in 2022. That would be an ultra negative thing for the markets. If the unemployment rate goes up to 3.9%, then I would 100% expect a massive day in the stock market, probably a 5% day for the markets. Now, I wish I could forecast to you guys what the unemployment rate is going to come out as. I cannot, but what I can say is what is going to cause these volatile moves, and it is going to be these data catalysts, because one data point that is not in our favor by a pretty big margin, right? Let's say unemployment comes in at 3.6%, 3.5%. That could mean the difference between new lows in 2022. This market is ultra sensitive. So that is my consensus view on this market. I think this rally could last a lot longer as long as the data does support it, as long as unemployment does not go down, as long as inflation does not tick back up, and as long as the Fed does not give us a higher terminal rate than 5 or 5.25%. I think this market could have some real legs to it, and the lows might be in for 2022. And depending how this data comes out is really going to affect what the Fed is going to do and where that terminal rate is going to go, which is the biggest concern of the markets as of right now. The second biggest concern of the markets is how are company earnings going to look like in 2023. If earnings come down in a big way, that obviously means valuations have to come down in a big way. If that happens at the same time the Fed is keeping rates too restrictive, it could mean more downside. But we just got through earnings season, so we have a couple months ahead of us until we're going to hear from companies again. So in a nutshell, guys, I do think this rally has legs to continue, and I do think the economic data will continue to support this rally over the next couple of weeks. But a lot of it might not happen in the indexes. It might actually happen in individual stocks, specifically stocks that did already report good earnings last quarter, guys. So that is it for this video. Thank you guys for watching. Hit the like button and subscribe to the channel if you guys made it to the end of this video, and also enjoy your turkey day. I will see you in the next one.